we've been accounting for provisions, which are longer term, potentially less certain liabilities. And the scenario is we're an excellent firm of builders who have been sued, or in the course of being sued by a major customer. We're resisting, but so far we've recognized, accounting-wise, that we ought to set aside 6 to prudently account for the possibility that we might lose. Legal case, so I have to settle it. We've got an expense, we've got no cash outflow, so we need to recognize that our provisions increased. There were none and they went to 6. Our cash flow in the period is that there isn't any. Does that make sense? Does it make sense that there's no cash flow? So we've got a loss. The loss we're recognizing is the expense, and the expense is a prudent, conservative, fair representation of the appropriate amount to set aside now, relating to things that happened in the past. Namely, we did the work that we considered to be excellent, that the customer is suing us over. So 6 is the liability to be recognized now in relation to that past event. 6. It's an expense this period because we didn't recognize it before. So we've got a loss in this period for that expense, but we haven't paid anything yet. Why haven't we paid anything yet? Because we haven't settled. We haven't been ordered by the court to settle, or we haven't settled out of court. So there's no payment yet. So there's an accounting item, this 6, that is neither a payment nor a receipt. So there's a difference. And then in accounting terms, how can we explain this difference of 6? Well, it isn't a payment or receipt. The potential, you might say expected, best guess of the expected future payment is 6. 6 is the difference between last time's provision and this time's provision. The provision went up. So the provision went up, although a loss of 6 might suggest a cash outflow of 6, there isn't any cash outflow. And we could say that 6 of cash still in the bank is represented by that 6 of a liability that's on the balance sheet. So the reconciling item, the increase in provisions, and the net cash inflow or outflow for the period, none. Okay, let us utilize a provision. So not here, let's do it here. Utilize, to use. Let's say paying, better way to say it, paying amount relating to a liability previously provided for. So another longer description, but I'd suggest that's more likely to remain clear. We pay an amount and it relates to this legal case. So our cash is going to go down. Let's say we pay them 5. Cash goes down by 5. It's a payment of 5. And so the utilizing bit says the other side of this accounting entry is, we say that 5 was covered by the 6 in the balance sheet. So we're going to reduce this provision. We'll use the provision. In accounting terms, it's covering the payment. In other words, we don't have to have any further cost because we recognize the cost for accounting purposes in period 1. And now there's a cash outflow, but there's no further expense because it's a cost previously recognized. So there has been a reduction. So let's move that down by 1 row. The reduction in the provision is the explanation for the fact that 5 has gone out of the bank account. So cash is down by 5, and yet there's no loss in this period. How can this be? Well, it could be, one reason for it is when we pay an amount that was provided for and we make the other side of this accounting entry. In other words, cash goes down by 5. What else is moving? And in this case, the other thing that moves is the provision goes down by 5. We reduce the liability. So that's the explanation why cash has neither flowed in or out when we look at the profit. The other way of looking at it is it a payment? Yes. If there's a payment, cash will go down. So cash has gone down. Why didn't net assets go down? Because we set the other side of that entry against this liability. So that we could say sheltered this period's income statement. There's no loss this time because we took the loss last time. The other thing that can happen is we might release a provision. I don't think we need this last column this time. So this time, let's say we release an amount. So releasing means we had a liability. In this context, we had a liability, and now we're going to make that liability go away. We don't need it anymore. And this time, if we don't have to pay something that we previously accounted for as if we would have to pay, then that's a benefit, and that's a profit.